So let's see, what do we got coming up? Oh, we've got some excitement coming up in Spring Splash. And I am talking with an attorney who is involved in one of the things we're going to talk about this week to see if I can get Hale Shepard, his law firm is doing a lot of work defending taxpayers in tax shelters. And Hale is going to join us for Spring Splash. But I wanted to see if I could get him to come and give us a special private clue in on conservation easement charitable contributions in this program, because it's one of the hottest tax topics going.
Yeah, and if anybody's not aware and you have a client who has a conservation easement or is considering investing, keep in mind the syndicated problem. And if you look at the recent guidance from the service on the settlement proposal, it sets forth like a bright line and says, if your return is anything more than this, it's, we're coming after it. So keep that in mind. But also, just I think 2 weeks ago, Lynn, on the Hewitt case, the 11th Circuit Court of Appeals was interesting because they declared the extinguishment regs, which is if it for any reason the easement has to be extinguished, property sold, the amount that you have to get back to the charity, what does the charity get out of it? And the court, surprisingly, the 11th Circuit declared the extinguishment regs invalid. They said the IRS did not follow the Administrative Procedures Act, and so therefore they declared those invalid.
That's one small victory. We're going to talk about another one in today's program, which we're obligated to start now.
Okay.
So welcome to Tax to the Max. I'm Lynn Nichols. My special guest this week is Ian Redpath. Ian is a talented tax lawyer and an educator. He's chair of the accounting department at Canisius University in Buffalo, New York. Am I at least close?
Well, the Jesuits call it Canisius, but the rest of us call it Canisius.
That association with the Jesuits has not led to his conversion, as near as I can tell.
Correct.
So this is a weekly symposium. It is everyone's comments are welcome. Your questions are welcome. This is a conversation about developments in U.S. tax law. All of our comments, mine, Ian's, and yours, are always informal and without research. We understand that. So you should consult appropriate authority before taking a position on any item discussed in the program. For myself, I acknowledge the value of my subscription to Tax Notes Today, published by Tax Analysts, which is, in my opinion, the preeminent source of current information for tax professionals coming out of Washington, D.C. What's on the program this week? 8 items. Fast-track ruling requests on corporate tax issues are supposed to be made in 12 weeks. We'll talk about that possibility. And then overpayment of withholding in a tax equalization plan for U.S. employees in a foreign jurisdiction is not refundable to the employer. We'll talk about what that leads to in the relationship between the employee and the employer and the concept of the confidentiality of the employee's tax return. New IRS guidance on worker reclassification. I must share with you, and I know Ian has some experience here, that we've worked on worker reclassification cases for over 30 years. The Section 530 relief and the 20-item checklist, which is now down to fewer items, which we're going to display and talk about. And then a look under the hood at a conservation easement donation settlement that's a little bit different than what Ian talked about. And Ian's our special guest, so I'll let him just summarize quickly what he's going to talk about.
Well, we're going to talk about a big issue, which is what do you do when your software populates the AGI right up front. The IRS has recently said that they are 11 million returns for 2020 and behind. 11 million. So there's a really a large chance that you've submitted a return for a client that never got processed, especially if it was submitted in October. Assume it hasn't been processed yet. So we're going to talk about what to do, because when you submit to e-file, you may get back a rejection because your AGI is incorrect that you've put in for your e-filing. So we'll talk about that. Talk about letter 6419 and what to do if the information is incorrect, and the same thing with the 6475. And then as you mentioned in our informal conversations earlier, the virtual currency issue and where we stand today and where we're heading with that, things we need to talk to our clients about and maybe change our client organizers to reflect these changes.
And I couldn't get sound effects, so I couldn't give you a drum roll. I'm really sorry about that. I'll take the lead on these first four, but Ian, I want you to really feel free to jump in, because I invited you because we need a lawyer's help here. Letter rulings usually take a long time. 9 months would be really short. Revenue procedure, the new revenue procedure gives procedures for issuing letter rulings, determination letters, information letters on specified issues. The user fee that you're going to pay to the IRS, generally for corporate matters, can be as much as $38,000. So 9 months is considered quick. What if you have a transaction that cannot or will not close without a ruling? We've got a buyer for our company, but they won't buy it without some comfort as to the tax, our tax positions. Income tax treatment is a key factor. How will earnings be affected when I settle up the tax issues? So we've got revenue procedure 2022-10, where the IRS announces an 18-month pilot program. Now, that's not 18 months to get your ruling. It's for 18 months. They're going to offer fast track processing at no additional cost of letter rulings that are solely within the jurisdiction of the Associate Chief Counsel Corporate, and they're going to get those done within 12 weeks if you follow the instructions to a T. What the IRS wrote is their information after receiving many informal comments from taxpayers. Informal comments, is that what they call complaints now? Is that what it is, Ian?
Yeah, I think that's what it is. And you mentioned 2022-1, and that just supersedes every year. 2021-1, 2020-1 just gives you the process of applying. But the other thing to look at here from the perspective of, there are issues that the IRS refuses to give rulings in. There are areas where they say, don't even ask us, we won't rule on it. And for example, if you had a question on whether or not you had a reorganization question, and the issue is the amount of stocks. So you did an A, but you had more than 50% or less than 50% of equity, more non-equity. The IRS says, we won't give you a ruling. I mean, don't ask us because we're not going to give it. Those are in that 2022-1. So you might want to look at that if you're thinking about a letter ruling. And now we have this pilot program, as you mentioned. And one of the great advantages here is that it's not need-based. It's an automatic. If you fit, and Lynn, here's where we get into the details, because it sounds good, but it only applies to anything under the jurisdiction of the Chief Counsel Corporate. So IRS Chief Counsel Corporate, it has to fall in their jurisdiction, which is under the Internal Revenue Service Manual. So they do corporate reorganizations, transfers to controlled corporations, distributions like return of capital, capital gain, redemptions, split offs, spin-offs, partial liquidations.
And you have to give, pardon me for interrupting you just a little bit, but in order to participate in this and have any hope of getting it, you have to give them all of the information that they list. You essentially write the ruling for them. If you don't just give them, so who's gonna write the ruling for you? Your lawyer.
Well,
what's that going to cost?
in addition here, you submit everything and submit to what they call what is called a pre-submission conference to go over the issues. So, how do we not know? Maybe we sound like we don't know a lot about this. 2022-10. Well, if you look at the date here, it just started. 1/14 of 2022 is when it started. So, like everything else with the Internal Revenue Service, we're going to have to kind of see where this goes, but it's very detailed as to what you have to provide them. And I agree with you, Lynn. Basically, you're saying, this is our position. We've done the research. This is what we're saying. This is this is really the authority we have for doing it. And then you'll have a submission conference, and hopefully you'll get a favorable determination or a favorable letter ruling.
Ian,
within this
on the subject of it being fresh, that's what this program is about.
Right.
It's about keeping your tax knowledge up to date on a weekly basis, rather than waiting for a semi-annual or an annual or even a quarterly tax update. This is where the action is. Every Thursday at noon, information developed from the current events of the preceding week. And here is something.
By the way, Len, if I could just add one other thing, the IRS has 7 days after you have, if everything you've submitted follows the revenue procedure, the IRS has 7 days after you've submitted it in which to either grant you yes, we're going to go forward with this, or to deny it, to say, no, we're not going to give you a fast track. For example, they might say, what you're asking us is a corporate question, but it's not within the jurisdiction of the associate counsel. So they have 7 days after you've submitted it to either deny you or to say, yes, we're going to move forward with it. And again, by the way, there's no right of appeal. If they deny it, there's no right of appeal. You just go through the regular process for a letter ruling.
I didn't mean to cut you off. I'm sorry, but I wanted to get to this. So many of our clients, especially our larger, more progressive owner-managed businesses, are doing business internationally. And in some of our offices, we are doing tax returns for executives of larger South Carolina-based companies that are sending their employees all over the world. Most of those employers will have some sort of tax equalization arrangement for their employees, their expats that are sent all over the world. A tax equalization program assures that the employee has the same net pay as they would receive under US tax law. But in order for that to work, the employer is going to, in my view, because the employer can't get a refund of the overpaid amount of US income tax. So they pay more income tax on behalf of the employee than the employee needed to pay as part of an equalization. The employee gets a refund. The employer can't get the refund. The employer paid the money. The employee gets the refund. So as I was preparing this, what occurred to me, Ian, is how much personal financial information should the employer require the employee to share? And in my experience with these, the employee who accepts the international assignment simply allows the employer to either prepare the tax, some people in the employer's tax department, or they get a special team that prepares the individual income tax returns for the employees that are on international assignment. And so you give up the confidentiality of your return in order to participate. Is there any way that the employee can protect themselves and still participate in the employer's plan?
I don't see any way that the court is going to uphold that. I don't think the court's going to allow an employer to say, you're required to give me all of your financial information. I need to know your brokerage accounts. I need to know what your spouse is making. I need to know all of this. And by the way, we're going to prepare your tax return in-house. I think there is just far too much confidential information that would be required there. I can't see any court upholding that provision should an employer require it. I think you can have an agreement with them that they're going to return or reimburse for any additional tax refund that they got. But to say that they're going to redo it, I think that's just going to be a step too far for any of the courts to go along with. I just can't see them doing it.
So the employer and employee should have as part of this tax equalization agreement, that the employee would return any refunds to the employer, and that would be enforceable.
Correct. Yes, then that becomes enforceable. And, if you don't agree with it, then you sue the employer sues the employee. And now you get into a court action where you can find out all their financial information and disagree with them. And also you've lost your employee, but no, I would agree with you. Any equalization agreement should have, that they would provide you with that information. So
very distasteful, even the prospect.
Yeah, it is.
Now, look at this form. This is an SS8. We've been dealing with them for a long time.
Mm-hmm.
This can be filled out by either the employee or the employer. It is a request for determination of worker status that is sent to the IRS officers who deal with worker classification, especially trained to deal with worker classification issues. They will make a determination based on what the answers in this SS8 are, and this will occasionally generate a field examination. So I thought, since we're going to talk about the form, this is what it looks like, at least the heading, but there's more to it than that. It's 4 pages long, 5 parts, general information, and then here are the only 3 things that really come into play in worker classification anymore. It used to be a 20-factor checklist. My observation is it is not. It's not 20 factors in the form SS8. It is who has control over what the employee does and when they do it, who has control over the employee's finances, over the arrangements for the finance, paying overtime, not paying overtime, et cetera. And what is the relationship of the worker and the firm? Can the firm fire the worker at will? Can the worker quit at will? That's a really oversimplification. And then part 5 is for service providers or salespersons. That's really different and outside the scope of what I wanted to talk about. But this form has been around for decades. What's new and what should we be thinking about? You mentioned the gig economy earlier, Ian.
Yeah.
Is the gig economy adding some sort of energy to this worker classification problem?
Yeah, and I don't think the gig economy itself is. I think, and I'm just going to disagree a little bit with you, Lynn, and because they've boiled it down into 3. And I've gone through some worker classification cases recently in appeals. And, it's interesting because essentially what they've done is they've taken the 20 common law rules and they've kind of broken them down into 3 categories. And so essentially they're still looking at them. They're not looking at them as 20 questions, but they're saying, well, these questions relate to behavioral control. These are the factors we're looking at in financial control. And when you look at it, it really mirrors the old 20 common law rules. So correct, the 20 common law rules essentially don't apply anymore. But my experience in working these issues is that they're looking at the same things. They're just focusing them and saying, these are the questions that constitute behavioral control. So the questions are essentially the same, just they're looking at it in a different context. But I think you have to be careful. I just handled a worker classification case in Wisconsin, and it was interesting because the IRS kept coming back and saying, well, they were determined to be employees under Wisconsin employment law. And I said, those are different factors. It's not an automatic. And I thought, okay, that's an outlier. Then I had the exact same situation in Ohio, and I had the exact same situation in North Dakota. And I'm going, wait a second here. There's a commonality. You're trying to apply different rules because, you know, being an employee, you can be an employee for unemployment purposes, for example, in a state, or you can be an employee.
And that was never one of the 20 factors.
It isn't. But I'm seeing, as I said, and this is in the last year, and I've seen now 3 different cases in 3 different parts of the country where they've tried to use state law to say, oh, well, you have to be. And the factors are totally different. And that's what I've always maintained and ultimately been successful on that. But it's interesting how they've tried to apply that as kind of a, well, the state said they were for employment tax purposes, or the state said they were for unemployment, therefore they're automatically. No, not at all. But, you know, that form is interesting, Lynn, and the SS8, I just want to point out to our viewers that there's another form out there that you really have to be careful of. If you represent the employer, understand that employees can file an 8919. And once they file that 8919, and I'm going to tell you right now, it does say to file the 8919, the employee has to have filed an SS8 requesting a determination of status. But let me just ask you this. It hasn't been filed, but the IRS gets a couple of 8919s from disgruntled employees that are saying, hey, you misclassified me. Not that they're employees, but you've been treating me as self-employed, and guess what? You've been misclassifying me. I was an employee. I don't have to pay, because that 8919 says I don't have to pay self-employment tax because the employer is misclassifying me. They should have withheld. They should have withheld the FICA, go after them. Now, I don't know about you, Lynn, but if I think if the IRS sees that, they're not going to say, oh, I'm sorry, we're not going to look at that because you didn't file an SS8. I think there's going to be a knock at the door saying, hey, make sure that you're misclassified.
But you're here, so make sure we tell the whole story. I'm not the keeper of all the keys. This is great. This is exactly what I want us to do. But I want to add here, as I read the revenue procedure 2022-13, all I got from it was something that's administrative, in that the employee has a right to get to tax court 1 notch sooner than they did before that revenue procedure hit. Now, the filing of the misclassification form, you're exactly right. That's usually where the trouble starts. It doesn't start with the SS8, and I thank you for including that. I want to just, that's it, right? We've got.
Let me add one other thing, Lynn.
One other thing. Okay, now wait a second. You can tell Ian charges by the hour. More thing. Just one more thing. Okay.
No, but I just want to remind people of the voluntary classification settlement program out there. So if you have a client that's got a huge issue where the IRS is coming after them for misclassification, consider looking at the VCSP, the Voluntary Classification Settlement Program, because the IRS does offer favorable settlement in worker classification cases.
And the IRS employee wants to get that case off their desk more than you want to get the case closed. They want to move it on and get on with it. So you have that on your side. Okay, well, there are the requirements to get the tax court jurisdiction. I've listed them. You can write them down, look them up. That was in the RevProc. Okay, in our opening, I promised you that we would talk about valuation, conservation easements. This is an article by Hale Shepard, who I have met and talked with and corresponded with. Hale represented the taxpayers in Little Horse Creek, which was the name was Propco LLC. He comments on several taxpayer favorable holdings by the tax court and the strategic use of something called a qualified offer. Now, I'm an accountant, not a lawyer. I knew I would need a lawyer to help us talk about this, so I'm going to hand the ball to Ian here in just a minute. But this decision illustrates that an easement case can be resolved when the IRS focuses on valuation instead of alleging technical flaws in deeds or other documents, like Ian was talking about in the case that he mentioned in the 11th Circuit. This case involves a contribution valued by the partnership at $21,619,000 by the IRS's appraiser at $18,355,000. Now that difference is much smaller than the difference we usually see in these cases. And that we were looking for a settlement until the IRS attorneys got involved and said, no, it's zero. It's not about the valuation, it's about a flaw in the deed. Well, Hale and his partners decided that the IRS was way off base, looking to the flaws in the deed. And so they used something called a qualified offer. They offered $1 less than the IRS's appraiser's own value. So if the tax court determined a value of $18,355,000 or higher, Propco would recoup its costs and fees because it would have received a settlement greater than it offered in the first place. So the IRS would have litigated literally for nothing. The IRS's only defense here was, well, no, Propco is a partnership, it's not a taxpayer. So a taxpayer is the only one that can offer a qualified offer. The judge literally threw him out of the courtroom, almost, and said, you guys are trying to, you're straining the net. The partnership is, in this case, to be treated like the taxpayer. And so the partnership wins. The IRS accepts the qualified offer, settle the case for the amount of the qualified offer plus $7,500 that was actually given in cash. But, and here's the bottom line. Here's the big question. Ian, what is a qualified offer?
Well, let me just say, a qualified offer is not just in the conservation easement. So, everybody should be aware of this. This is a tactic, and it really is important to understand really what you're saying. And the only thing I would disagree is normally what you're going to do is offer $1 more, not $1 less.
I'm sorry, Ian, there was the $7,500 in that I.
Okay, because normally what you're going to do is you want to make sure that because if they come back with exactly what the IRS said, you don't win. So what you're going to do, what you're basically doing is you're giving the IRS 90 days to respond to you. So you're saying, look, I think we have legitimate position. I think we're going to win. Here's our position, and you get the 30-day letter, for example. Now, you can only get costs, and this is why you do it. You actually say to the IRS, look, here's what we're going to offer you. If you don't get more when we go into court, guess what? You're going to have to pay us for all of the costs going forward. You got to pay us all of the litigation costs. So now, and you mentioned earlier, the IRS, and as I mentioned, there are 11 million returns behind from 2020. The IRS is so overburdened right now that what's going to happen? They're going to look at this and they're going to have to now take you seriously. It's not a game anymore. It's not something where appeals, for example, can sit there and go, yeah, well, go to tax court if you don't agree with us. Okay, we'll go to tax court, and you're going to be the one responsible for all of the costs after this point. So essentially, what you're doing is you're making a qualified offer, and
which you're willing to pay. This
is what we're willing to pay. And frankly, here's the language. I'm going to give you the language. Okay. So I know you said I charge by the hour, and you're wrong. Lawyers charge by the word. So I'm going to give you the language, okay? So I know everybody's saying, oh my God, we're going to be here for 5 hours as a lawyer tries to tell us language that's out there. No, here's the language. My clients offer to accept liability of X amount, $1,000, exclusive of interest, because interest, that you can't get out of, exclusive of interest, but with no penalties or additions to tax, to settle their 2018 income tax liability. Boom, that's it. That's my offer. And all I have to do is say in the document, I say the settlement offer is designated as a qualified offer for the purposes of Internal Revenue Code section 7430. If you have multiple years, you're going to use the same language multiple times. You know, if our 2019 return, our 2017, you're going to do it. Now, I'm going to point out, and if you look at the number A, an A here, rather, letter A, what is the time period? Well, essentially, you get your 30-day letter, your RAR, right, on the audit report. Normally, at that point, then, right, you have 30 days to appeal. You'll file, then, your qualified offer. Or you may go to appeals. You don't feel this is getting anywhere, you file. You essentially have to file from the 30-day notice you get, the notice of an assessment from the IRS. This is what we plan to assess. You have 30 days to until 30 days before the trial. So you can actually do it, and I've done this before, where I've had a case, for example, in tax court, and the IRS counsel, don't feel like they're being very cooperative in this. I'm going, okay, fine. Here's a qualified offer. Hasn't gone to trial yet. Here's our qualified offer. Go ahead. You want to go to trial? Let's go to trial. Trials can be quite costly. I mean, let's be honest. Going into trial can be quite costly. So what is the IRS going to look at now when they get this qualified offer? Is they're going to look and go, well, do we really want to go to trial? You know, trial is going to take a long time. The IRS is overburdened, and we could get stuck with costs. So it's not something you do frivolously, but it really tells the IRS, look, we're serious here. Here's your offer, because the IRS can get costs. Now, one caveat is you have to exhaust your administrative remedies in order for the IRS to move on it, which means essentially go to appeals. But if it's sitting there in appeals and they've got that qualified offer, okay, what are they going to do with it? If they don't answer in 90 days, it's deemed rejected. Now, what does that mean? It means now, hey, we move forward. Guess what? We don't win. You don't win. You don't get, winning means you don't get more than we offered. You're going to owe us costs. Here's the problem to think of. And I'm getting a little bit into the weeds. I don't want to here, but for example, I don't want to, I'll give you a great example. I had a case in tax court. The IRS wanted to concede. They said, well, we're going to do a settlement. We'll settle. For less. And I said, no, I want you to concede in court. Why? Because if we had settled, they're going to say, well, you aren't entitled to anything because you settled it with us. Whereas when they conceded the case in court, that means they've agreed to they've agreed to it, and now I can go get my costs. I know it's a technicality, but these are things that have to be considered. But there is a net worth requirement, and this is something to keep in mind, that an individual has to have a net worth of $2 million or less when they file the suit. And for a partnership, corporations, it has to be 7 million or less. And they have to have, by the way, businesses have to have under 500 employees. So
this is all why this is all why the CPA does not, cannot, should not try to do the whole job. This is why, even though you know about a qualified offer, you probably want to engage your attorney or your client's attorney if you're thinking about putting a qualified offer together. Now, Ian mentioned when we were kicking things around before the program started the difficulty, and he's mentioned a couple of times, the difficulty the IRS has. I filed amended returns on behalf of my son on the 14th of October, 2021. I sent it by certified mail. I got the receipt back. The IRS signed for the return on the 15th of November, 1 month later, and we haven't heard squat about that return. So my personal experience with a member of my family is that they're impossibly behind, at least in Austin, Texas. It's worse than slow. You got to file a 2021 return to get a refund. What does the IRS suggest? What does Ian suggest? And in case you're wondering what that picture is, that's a sloth. Noted for going slow. Ian, please, what is your advice here?
Yeah, and I just want to make one comment on what you said, because we know that the Biden administration they made a proposal on things like notifications on that $600 with the banks, and that's kind of gone away. But the idea of putting more resources into the IRS and the collection, and honestly, the CBO, so it's a bipartisan, the Congressional Budget Office has said that, and this is interesting. They said, yes, putting more resources into the IRS will result in net revenue to the government. However, it's conditioned on the following: that the IRS is able to hire experienced and qualified tax professionals. So what does that tell us? It tells us that the CBO is essentially saying there's issues. And they said that. They said there's been so many retirements from the IRS, and they have been hiring, according to not just the CBO, but to the Treasury Inspector General, has said that they've been hiring, I'm going to say, younger, inexperienced, or no experience, and not properly trained. So just keep that in mind, some of the problems that are going on. So what do? Well, the IRS has said that, in order to validate and successfully submit an electronic filing, the adjusted gross income has to be there. But that return hasn't been filed or hasn't been processed. So you're going to populate that, and what's going to happen? It's going to come back rejected because the IRS doesn't show that as the AGI. What they said is, you put 0. So if the return hasn't been processed, put 0. If you send it back, it gets rejected. Look at the taxpayer's transcript to see if in fact the return has been processed. If they use the non-filer tool to get the advanced child tax credit, you're told to put $1 in there. So return hasn't been processed, but they didn't use the non-filer tool, put 0. If they use the non-filer tool to get an advancement on their child tax credit, put $1 in as their AGI. So that's what the IRS is telling us to do for these returns.
I'm sorry, I was distracted.
No, that's fine. By the way, I don't know if we have any, if anyone is an enrolled agent, or if there's any firms that have enrolled. I know many firms hire enrolled agents today. You might want to remind them to look at the new publication that just came out this month, publication 5186, because that details exactly because they have to renew their registration as an enrolled agent every 3 years based upon the last digit of their social security number. And also they have continuing education requirements with the IRS. And again, that goes by the last digit of the social security number. So new publication 5186 details that if anyone is an enrolled agent, or if you have any enrolled agents on your staff.
I was distracted, Ian, because I was sending a message to ask for monitoring the chat room. We've not received any questions, so these usually show up in the chat. So I was asking SCAPA staff to monitor the chat and just let us know that there are questions and actually read the questions, because on my screen, I can have the slides and I can have pictures, but I don't have the chat function. So with that,
We're here to answer questions too.
Pardon?
I said that's what we're here for too, is to answer questions.
Right. No, I did something here. Oh, here we go. All right. Ian, you wanted to talk about the child tax credit for 2021. This is it.
Yeah, and remember that we have, and keep in mind that, we have the child tax credit, we have the enhanced part of it, which was the additional going up to the 3,600. But we got
that form letter.
Yeah, and this is important because the IRS came out right at the end of December and said, oh, by the way, if you got an advanced tax credit, if you've got the advanced child tax credit. So remember, beginning July 15th through the end of the year, the IRS up to $300 monthly, and that started in July. If you received that, and Lynn, our next slide, it tells you that the client, married filing jointly, each spouse separately will get this letter 6419. The 6419, according to, and you have news release 2021-255, as I said, it was the end of December. They said, we're going to begin issuing these in January. So one of the things you have to ask your client is, did you get a letter 6419? If you, I don't know, Lynn, but maybe it's just me, but when I deal with clients, they often go, what letter? I never got a letter. IRS never, I heard that too with the EIP payments. They go, I don't remember getting any money from the government. So
was I supposed to get money?
Right. I just thought that money that went into my account just appeared magically. So we know that they're supposed to get a 6419, but I think all of our experience over the years, Lynn, will tell us that those numbers that the IRS gives us on things are not always correct. Those numbers, what do you do? And here's, I think, what the problem is that, we're asking the client for a 6419. And what is the client going to say? Client may very well say, I never got one. I don't have it. I don't have a 6419. I didn't get a 6419. Well, the first thing I'm going to ask the client to do is to go and set up an account on the online portal for the client. I can't set it up for them, but I can work with them right there, set it up, and they can go in and it will report the payments they got. So this is what the IRS says the payments are. Absent that, if they're saying they didn't get a 6419, or here's the other problem, they got a 6419, but the numbers aren't right. I'm looking at going, this is wrong. This is not correct. Maybe they changed. They had a change. Something changed, and the IRS screwed it up. Hard to believe the IRS could screw up anything, right? So we get the numbers that aren't there. So what do? Well, call the IRS. Yeah, right. Try to get through to the IRS. You can sit there, even if you have that, what is it, NQ, where they supposedly you pay for them to sit on the line for you and hold. First off, let's assume you get through after 4 hours of waiting. Do you think that person is going to be able to change the numbers and make an adjustment? Absolutely not. That person's not going to be able to do anything for you on this. So what do we do? And I guess that's the question, because we're going to see this issue with the 6419. One of the things the IRS is recommending against, and they're not telling us what to do, they're telling us what they're recommending we don't do, is file amended returns. The IRS says we're so far behind right now that filing an amended returns. So what some people are saying is, well, use your records and file and wait to see what happens. Well, you know what's going to happen. If the IRS has a discrepancy between the numbers filed and your numbers, you are going to get something from the IRS saying, hey, you reported that this is not correct. You didn't report everything that you got. You're wrong. Or saying your credit is greater than it should be because you aren't taking everything that you got in consideration. And so, you know, some people say, do it, file it using your numbers and wait to hear from the IRS. I think that's going to create a huge flag item. Others say, use the IRS figures. That way you get a refund quicker, and then file an amended return. IRS is so far behind. They're saying, don't file amended returns. You know, that we don't want that. So what do you do? Well, you know, in my mind, Lynn, what you do is you report using the IRS numbers. You then make an adjustment to the credit and you file a disclosure statement saying, you know, here, this is what we actually got. This is what was reported on the 6419. This is what we actually got. That way, the computer's not going to throw you out and say, hey, your numbers aren't correct. You have disclosed your position. I think that's the way to do it.
Thanks for that. Now, our next issue is when we get denial of a child tax credit.
Yeah, I think this is something you have to talk to your client about, especially a new client.
There's another form here too, by the way, another letter, 6475. I may have that in the wrong order.
Yeah, let's just remember that the child credit is part of due diligence. So you have a due diligence requirement on that. The other thing I would like to point out is, and this is missed a lot, is if you are denied the child credit, you have the potential then of having it denied for the future. So if a client comes in, it's not just enough that they've given you the information for the child credit. There's a 10-year period after the most recent tax year for which there was a final determination that your claim was due to fraud.
Excuse me one second. Let me get on the right page here.
Yeah. If you go back before this, you go back.
Go back
one more.
Okay.
There. So it's a 10-year period if it was due to fraud,
Yep.
but it's a 2-year period if it was just reckless or disregard for the rules. So that means essentially that a client can come in and maybe they're not entitled to the child credit at all because they were denied in the past. So that's not usually a question we ask them. It's not usually part of our client organizer. I'm saying it should be, so that you're aware, were they denied? And especially a new client. It's something that should be flagged in your file that, hey, they can't take a child tax credit this year because of the 2-year period. Most of it's going to be the 2-year denial.
That may be exactly why the client showed up in your office as a new client.
Exactly.
They thought the old accountant was not telling them the truth, or they thought if a different accountant prepared the return, it would just kind of slide past and they would not have the limitation period where they couldn't get the credit.
Right, exactly. And that's part of as the next slide, the due diligence, that keep in mind that Form 8867, you have to perform due diligence.
Purpose due diligence thing, right?
Right, but yeah, if you can see at the bottom here, the earned income tax credit, the child tax credit, the American Opportunity Credit, the advanced credit. I think that that's a question you need to ask. I think part of your due diligence is that question. Is it denied? I mean, make sure that unfortunately, a lot of times people assume things, and so they answer the questions on the due diligence. And Form 8867 is going to ask you that question. And sometimes, though, we just answer the questions assuming the answers and not actually doing the due diligence. So it's really important that you've actually asked that question of the client directly.
Excuse me. Sorry. We have a question in the chat from Ethel. Says Drake does have a question about
Hold
the
on
denial.
one second. The sound may not be exactly what we need. I'm going to go to chat. Okay, we have a comment from Ethel. Is that what we?
Yes, sir.
Okay. May I read that? Drake does have the question about denial in the due diligence questions. So Drake Software has a question about the in the questionnaire that the client is supposed to make a representation
Right,
about the
and-
denial.
Right,
Right.
and again, that's why I mentioned that you need
Thank
to
you.
actually
Thank you, Ethel.
pursue that. You need to have documentation when you've answered that. And that's why I would suggest that that's a question you would want to have on your client organizer, you know, so that the client is answering that question as to that. Because again, far too often we assume things and we answer the questions and we haven't actually made that actual inquiry. We don't have anything in our file to back up that, oh, no, you haven't been denied. So that was my my caution on that.
Hopefully we have a relationship with our clients that is based on mutual confidence and trust. And it's it shouldn't be the risk with the existing client, but it certainly should be thought of as a risk with the new client. Over the years, I have had risky situations presented by new clients who really came to me because they didn't like the answer they got from the old accountant, and the old accountant gave them the right answer. And I was going to get a different set of facts, or to be careful. That's all. And you know,
Lynn, I learned a long time ago, and this is something I've always remembered. When I first got into practice, my senior partner said to me, Ian, always remember, your clients are not your friends. They may be acquaintances, but screw up one time and see who they throw under the bus. Said they're not your friends, and I think that's really something that I've always remembered. That, you know, and you know, Lynn, just to bring something really home quickly, I was asked to testify on behalf of a very prominent tax lawyer. Firm is excellent. I'm sorry, tax accountant. The firm is excellent. He's excellent. He got sued by his client. The lawsuit was ridiculous, but his malpractice carrier had to defend it. The client came in. The client did not have a 1099. He did not have the 1099 for a distribution from his IRA retirement account. He said it was 200,000. Gave a great explanation as to, he knew exactly how much it was. Here's what he used it for. Needed the return prepared immediately. They had prepared the returns for the family, the business, for years, way beyond him. This was the ne'er-do-well son-in-law that was now running the business. And unfortunately, he trusted him. He said, okay, couldn't, for whatever reason, they couldn't get a copy electronically at the time. The system was down. So he just went ahead. They filed the return electronically. They got a notice from the IRS. It was $800,000, not 200. So here's a long-term client that he's just been believing. He goes, well, I would no reason not to trust him. Yeah. And so he sued him because he said, basically the lawsuit was, I lied to you, but you were negligent in believing me. And honestly, that's exactly what the lawsuit said. And the second part was, you were negligent in not telling me that if I lied, I could get caught because you failed to explain the matching program to me. So
and
there you go.
Professional liability carrier settle?
You know what? I don't know, because I never got called as a witness. So I'm assuming they
Wow.
settled it out of court for something.
Very unfortunate.
Yeah.
Very unfortunate. So there's the letter 6475. I'm going to push us along just a little bit.
Sure.
This applies to that third round of economic impact payments. The so-called plus-up payment.
Yeah.
That's pretty straightforward. I know that we all want to hear what Ian had to say about cryptocurrency, virtual currency. This example, there are more virtual currencies than this now, but this example illustrates some of the virtual currencies by their symbols in which your clients or my clients might engage. Some are almost proprietary. Some are like the Bitcoin, which is up here in the upper left-hand corner. Some are widely held. But with that as an example, Ian, you've done the work here. I'm going to hand you the ball.
Okay.
And you tell me when you want me to change slides, all
Okay.
right?
Well, let me just, I just wanted to go back to one thing with that letter 6475. If you receive it, the numbers aren't correct, what you should do is include it in income, include into income the numbers on that. And then what you're going to do is back it out. And that way you don't cause problems with the IRS computer. So that's what you want to do on that. All right. So what's going on with cryptocurrency? And you know, before we started, we had an interesting conversation with Stephen, started a conversation about this. And, you know, virtual currency is no longer the term going forward. It's going to be digital assets, which could include tokens. It's a digital representation of value. The representation, and this is where people get all, they don't understand it, is that it really, the IRS didn't understand it. And so what the IRS finally did is finally they came around, and in 2020, and if you move to our next slide, in 2020, you know, they moved to the front page of the 1040. And if you can move to the next slide, Lynn, if you look at the bottom in 2020,
I need to be retrained. Yeah.
the question at the bottom read, anytime during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in virtual currency? The 2021 form is going to read as it does at the top. So our second bullet point, it's going to say, did you receive, sell, exchange, or otherwise dispose of any financial interest in virtual currency? Now,
Wait a minute. Wait just a minute. I normally would think of a disposition as being the only taxable event. But if I acquire virtual currency in exchange for, let's say, a personal asset or in exchange for services, the acquisition could be a taxable event without any disposition. Am I on the right track here?
absolutely. And again, the reason they changed this is if you look at the first, did you receive? They said, well, that really would, if you acquired it, you've received it. But if you look at the other language, it doesn't really talk about disposition. So that's why they said, well, receive would include acquiring. We're going to add disposition so you know exactly what you need to be reporting. So that's why the change in language was put in. Don't leave it blank. If you want to be hearing from the IRS, leave that question blank. So, you know, you'll absolutely get a get a flag from your software if you leave that question blank, because the IRS is seriously looking at that. So again, don't in any way leave it blank. So again, if you look at the next slide here, Lynn, yes, well, a transaction involving virtual currency, and again, moving forward, and we'll talk about this, but there's going to be reporting requirements in 2023, but a transaction involving virtual currency, receipt of virtual currency as payment for goods or services, the receipt or transfer of virtual currency for free without providing any consideration that does not qualify as a bona fide gift. All right, let's look at those first two. Last year, a lineman for the Carolina Panthers, with approval of the NFL Players Association, got half of their salary in Bitcoin and half in cash. That's still income. That's still the W-2. You know, that gets reported on the W-2. There's going to have to be withholding on it. So interesting phenomenon now for the Carolina Panthers. How are we withholding on the Bitcoin amount? I guess we're going to reduce the amount we put in Bitcoin. So, there's going to be, there's the reporting issues. Quite common now. The NBA and the NHL and Major League Baseball, a lot of the athletes now are requesting to be paid in Bitcoin now, or in virtual currency. If I say Bitcoin, I'm using that generically. I mean virtual currency. It's just common. Bitcoin was kind of the first one on the block. So either one of those. Now, the other thing is, there are a lot of people out there that work in what's called the gig economy, as you mentioned it earlier, Lynn, and they get paid in virtual currency. They don't get paid in cash, they get paid in virtual currency. Well, that's still compensation and has to be reported. So, if you're a Schedule C employee, you got to pick that up on your Schedule C. The problem is it's not reported to the IRS. So therefore, does that mean it's not taxable? Well, not at all. So there's all of these issues to deal with. The second one, I had a client that said to me, well, I asked them about Bitcoin. I was talking to them about virtual currency, and they said, I opened this online gambling account, and they gave me, as part of it, they gave me virtual currency. And I said, well, how much? They said, I don't know, like $20. I've never even looked at it. I said, okay, well, that's income for you, isn't it? They didn't give it to you as a gift. Never thought of it. And unfortunately, by the way, never reported that they had it. So therefore that question, do you have an interest? No. Did you receive? No. Never thought about that. And then the next one, the receipt of new virtual currency as a result of mining or staking. Or the last one, a hard fork. Well, mining, staking, a lot of people who mine the coins, basically looking at the value, and we could spend 10 hours going over those last two. That's really a big thing that the IRS is going after. A hard fork, what's that? That would be similar to a stock split. So you have an account and then it splits. So you have your old account and now you have your new account. So kind of think of it like a stock split, but yet they can have tax consequences. So, this is because
I need to hold my hand up. Ian, if I am fortunate enough to engage in a mining activity, and that produces a Bitcoin, is that any more taxable than mining for gold and digging it out of the ground, but I haven't sold it or used it as collateral? I haven't used it in any way. That would not be taxable.
Well, the IRS may not agree with you on that. So they'll agree with you on that, but they won't agree with your analogy. So that's the problem.
Okay.
Let me put it this way. The IRS is having a hard time getting their arms around this because it is changing. It's probably changed since we started talking, right? The technology, as I mentioned earlier, sometimes I look at this and it's daily things are changing in the technology, and I got to find a 12-year-old to figure out what they're doing in Bitcoin or in any of the virtual currencies. But I turn on the television and here's Matt Damon out there looking out at Mars, telling us that only going back to the Roman times, having courage to enter the unknown world of virtual currency. So it's just another virtual currency that he's out there. It's a really different world, and just having it. So if I have it, think of a wallet as like a debit card. Okay. Your wallet is, you got that money sitting out there, you can use it, but you don't have to.
Before we go too much further, where do you want to tell our audience that the IRS has given notice that they're going to use the John Doe summons to get information about all the accounts? They'll have a scope, all the accounts say above $20,000 in value, but they're going to use a John Doe summons, which means they'll have all the information about your account in their possession. It's not like you get a 1099 and you have control of the facts until the IRS pries them loose. If they have issued John Doe summons, they know everything they need to know before they walk in the door.
Yeah, the IRS
There's no way to hide your activity here
Yeah.
with regard to virtual currency, because all of the exchanges are going to be subject to the John Doe summons tactic.
You know, that they're backdooring today, and a very good point, Lynn, that's excellent. They're backdooring the reporting requirements. And essentially what they're saying is, well, you have till 2023 to do the reporting, but we want to know who has accounts with you, and we're going to issue these John Doe summonses. And the issue is, you're going to have to report this. You're going to have to report what you got. And I'm going to, for some reason, my phone was not off, which it should have been. I apologize. You're going to have to report this. And, that's how they're going to get the information. People, unfortunately, people think, I didn't get anything, so I don't have to worry about anything. And that's why it's so important for us to ask the right questions on the client organizer, but also to sit down with the client. And now's the time to do it, because it's only going to get worse from here. It's not going to get any better. It's only going to get worse. We need to have the clients understand that this is not just something that we get to play around with out in the cloud, and it doesn't have any tax significance. Now,
I want to ask a tactical question.
Yeah.
I'm not certain. I've messed around with this stuff. I'm not certain of the amount. And so it's not very much, maybe it's a couple of $1,000s, and my income's 150,000. I'm not going to be bothered with putting anything in the return. Am I in better shape, or should I, if I just have an uncertain amount, should I just pick a number and put something in the return without worrying too much about defending every jot and tittle? Is this one of those places where, as long as I've got something in the return, I'm not going to be in the kind of trouble I would be in if there was no number at all?
Well, yeah, I think,
Counselor?
I think the problem that everybody is going to have, and I wanted to point out that on our second bullet point, if you've just used cash, including PayPal or Venmo, to buy virtual currency, you're not required to check that box yes. Okay, just buying it is not enough to check the box yes. If somebody gave it to you as compensation, yes. If somebody gives it to you for services, for goods, if they give it to you because you opened up an account in something else and it's not a gift, yes, that you have to report. But just buying the coins itself is not. The problem is, and it's our last bullet point here, is people don't understand.
Wait, Ian, why did I buy them?
Pardon?
I bought them so I could pay bills with them.
Well, then once you start doing that, and that goes to our last bullet point here, Len,
Exactly.
is the 8949. What is virtual currency? Well, the IRS says that virtual currency is, or cryptocurrency or digital assets are property. So you treat it like property. Now, if you take it for services, we know that the IRS says, well, let's take this example in. It's not virtual currency. I transfer to you as compensation 100 shares of Microsoft stock. Well, we're going to have to pick up as compensation the fair market value of those 100 shares, correct? No different here. What is the value of the property, now the virtual currency? And that has to be picked up on the W-2. So that gets picked up on the W-2. Now, it could be, if I got virtual currency as services as self-employed, for example, in the gig economy, I'd have to pick it up on Schedule C. If I used it to purchase inventory or services, well, what I really did, Lynn, is I disposed of it. So
Exactly.
I have a basis. this is where the problem is. Most of our clients aren't keeping records. So what's my basis in the cryptocurrency that I disposed of to buy these assets or to pay you? What was my basis? So I'm reporting this as a property transaction. You're picking up the income, but then that's giving you a basis in the cryptocurrency that you got. But right now, people aren't creating, they don't have good records generally on basis. Some exchanges do have records. Some are not so good at keeping records. So it's an issue that it's like anything else. You know, the IRS can come in, as we all know, they can come in and say, if you can't prove your basis is zero. I've never had that happen because we've tried to come up with their basis. Maybe it's going to be something we have to disclose as to how we created the basis.
Took our eye off the, I'm sorry to interrupt you, Ian.
Sorry.
We took our eye off the clock. I want to be courteous to all of our participants. The material that's in these last couple of slides, we really have talked about. We've really covered it in that the act that that you refer to here, what it requires us to do, we've really already talked about, and the definition of brokers. We're going to see the brokers reporting all that. So,
by the way, the $10,000 rule, don't overlook that, because the $10,000 reporting, the cash, that's going to apply to cryptocurrency also.
Right. And
2023 though.
In 2023.
Right. But I was asked earlier by Stephen, and I think, what is this going to look like, this report? It appears it's going to be similar. It's going to be a separate form, like we came out with the 1099 NEC as a separate form. I'm assuming it's going to be a separate form, 1099-something, but it's going to look very much like the investment, like a broker, like a 1099-B. It's going to have the date it was purchased, the basis, the sale date, the proceeds. So, that's what I'm thinking that it's going to look like. I think what's also going to be interesting is, are they going to start applying things like the wash sale rules into transactions? I'm thinking they're going to.
It's going to certainly be interesting. And one of the things that makes it interesting is that the cryptocurrency has market fluctuations, whereas dollar-denominated assets really don't. My basis can be expressed in terms of dollars. The sales price is expressed in terms of dollars, and the basis, the purchase price, doesn't change from the time I bought it. But cryptocurrency can change in any one of at least three ways. So, Ian, I thank you so much for your input and what you've done for us this week. Let's continue to meet for lunch. All of those who are supporting this program every week, Thursday at noon. We will have guest experts on topics like Ian, as well as today, to give us the lawyer's point of view and make a valuable contribution to what we CPAs might know. If you have a question, perhaps someone in the group can help. We help each other. Questions about topics and can be submitted after the program is over. I will monitor the chat. I do monitor the SCAPA chat function and undertake to answer all questions as quickly as possible. Thank you again. Stay safe. We need each other.